Hi, everyone. I'm Martin Lefebvre, Chief Investment Officer and Strategist at National Bank. Welcome and thank you for tuning into our NBI podcast series. Our focus today will be interest rates and opportunities in the fixed income markets. And to do so, our guest is none other than Ian Stealey, International CIO at JP Morgan. Mr. Stealey is Managing Director and Head of Global Aggregate Strategies within the Global Fixed Income, Currency, and Commodities Group. He's based in London and he's a portfolio manager focusing on multi-sector bond strategies. And within the global aggregate team, he was previously responsible for the portfolio management of enhanced cash and short duration portfolios. Ian, welcome and thank you for being with us.
Great to be here. Thank you very much for having me.
Excellent. Ian, before we jump into what the fixed income market has to offer at these levels, let's start by giving a little bit of context on the current economic environment. In previous podcasts, we've talked abundantly about the necessity for central banks to rein in inflation, but markets don't seem to agree what the end result will be with, on the one hand, bond markets pricing in higher yields for longer, while on the other hand, credit markets seem to be trading sort of the pause and soft landing scenario, with spreads still not indicative of a recession to come. What's your take on the question? Is the Fed doing enough or too much, and what factors should be influencing the decisions from now on?
So I think the Fed has been on a bit of a journey over the last 12 months or so, from a position this time last year when they obviously weren't doing enough, where they were behind the curve and they weren't reacting to the price pressures that we saw out there. But they've obviously had a very strong influence over the markets over the last 12 months, where they have been very aggressive, and we've seen the fastest pace of rate tightening since the early 80s. And we've now got rates up to what you would perceive is a restrictive position. Yet, as you point out, it's not really slowing the economy yet to the state that the Federal Reserve themselves would probably have hoped it would be. Now, we are very much aware that the rate hikes that go in, the tightening of monetary policy, has long and variable lags to the impact to the US economy. And I think what's different maybe this time around is that we're still in that sort of euphoric period of COVID reopening, where we're still seeing a lot of activity. There's still a lot of pent up savings. There's still a lot of people that want to get out and do things that they hadn't been able to for such a long period of time. And those long and variable lags are just being longer than through previous cycles. So I do feel that the Federal Reserve has done a lot. The market is still pricing them to do a decent amount more. We've got another almost 100 basis points priced in today. And I think they're going to be wanting to see what the impact has on the US economy, both from a inflation standpoint, so what's happening to prices, but also from a jobs standpoint, what's happening to the unemployment rate, and whether we are seeing whether it does finally move higher. So I believe they will be reacting going forward to the data, and I think they're in a position where they do feel they've done a lot. They feel they can do more, but they do want to see how the data plays out. So I think it would be more data dependent as to how they react going forward. And I also think some of these maybe oversized hikes that we saw last year, the 75 basis points, those I would hope are a thing of the past, and we are more in a traditional rate hiking cycle of 25 basis points, given how much has been done in such a short period of time.
So Powell was just talking in front of a Congress lately, and he sort of opened the door to a 50 bips increase. Is still a possibility. So what type of data would you see or would be needed to incline him to do so?
So I think there's really two bits of data that we're expecting to see over the next week. Firstly, we've got the jobs reports, so the non-farm payroll reports this coming Friday. Obviously, we had a blockbuster report in January, much stronger than anyone forecast, and I think that really started this movement higher in yields and the repricing that we saw in the fixed income markets. So I think that report's going to be very key. There's a lot of discussion about perhaps a milder period in January following quite a cold spell in the run up to the end of the year, and are there any seasonal impacts of that, and how is the strong jobs data we saw in January, is that a start of a new trend, or was it more of a one-off? So very, very close attention to that this coming Friday. And then we've got the inflation report next week. So again, that was the other sort of conundrum for the Federal Reserve last month, was that actually inflation didn't fall to the extent that they were hoping it to, both on the headline and on the core side. And I think they will be keeping an eye on that. The expectations are that both headline and core CPI year-over-year numbers move down for the February report. But again, obviously that's going to be a key determinant. So I think those are the two key data points. And if they are both strong beats of expectations, if we see another, I don't think we're going to see another 500,000 job gain in the US, but if you see those sorts of numbers, if we see inflation move higher year over year, then yes, as Powell indicated today, maybe they will revert back to 50 basis points.
All right. Turning to Europe, in the midst of the war in Ukraine and energy prices jumping up, many people were expecting a severe recession in Europe in 2023. Now we see that gas prices have come down, China is reopening, and it seems everything is getting in order. What's the ECB, the European Central Bank's approach to monetary policy, considering all of this uncertainty?
Yeah, and I think Europe's a very interesting environment at the moment, and you're right. We had a period where I think the Bundesbank at some points last year were talking about a possible 5% GDP decline in Germany based on the increase in gas prices following what was going on in the Ukraine. But the reality is, Europe, through some of its own good work, they filled up the gas storage tanks, but also through some period of good luck. We had a very mild winter in Europe, meant that actually gas supplies weren't diminished or to the extent that had been expected. Gas prices fell, and the European economy did not have that deep recession that many expected. And actually, the European economy seems to be bouncing back pretty nicely at the moment. And then the ECB have got an environment which is, you would argue from a pricing standpoint, even more challenged than the US, because we're not seeing core inflation falling yet. So although the Federal Reserve will not be happy in the US that core inflation is still elevated, it is on a downward trajectory, albeit slowly. In the Eurozone, that's not the case. We're seeing core inflation continue to move higher. And just in the way the basket of core inflation will be monitored over the next couple of months, that is likely to continue. So you've got a European Central Bank that was even slower to the rate hiking party than the Federal Reserve was. They only started last summer. They're still kind of behind in magnitude of rate hikes relative to a number of other central banks in the world. So it feels like they've still got a lot to do. And we had the Austrian ECB council member yesterday coming out saying that they could see 4 more 50 basis points hikes. Now, that's at the hawkish end of maybe expectations, but I think that shows you some of the work the European Central Bank still need to do. And our base case at the moment is that we will see more hikes from the European Central Bank this year than we're likely to see from the Federal Reserve.
Yeah, and if they do so, that will certainly help the euro regain a little bit of strength on the way forward. Are there any other major central banks that we should be focusing on when it comes to monetary policy? I mean, we look at the Fed, we look at the ECB. We're starting to look a little bit more about the Bank of Japan. But are there any, major central banks that do have an impact and should be followed?
I think you've hit the nail on the head there. I think it's the Bank of Japan, which is a really interesting central bank. Obviously, when you look around the world, there has been paces of magnitudes of central bank tightening, but the one outlier out there remains the Bank of Japan, who are still in negative interest rate territory and have still got yield curve control in place. So they're still effectively supporting the bond market through purchases, at the same time as we're seeing quantitative tightening from a number of other central banks around the world. Now, Japan's inflation outlook hasn't been as severe as, say, the US or Europe, but it is definitely moving higher, and it is definitely moving to levels that doesn't warrant zero interest rate policy or negative interest rate policy and yield curve control. And it's now, I think, just a sort of a matter of when, not if, they start to, or they continue to remove the bans that have been put in place, and then start to look at normalizing policy. And what we've seen over the last few months is they seem to want to surprise the market. So the last yield curve control band move was in December, when the market wasn't expecting it. There was then a view that they could do more in January, but they didn't. We've got a meeting coming up this coming Friday. I think the market expectations they will not touch it, but there's always a risk. And we're also seeing a shift in leadership in Japan. So Kuroda is taking or ending his tenure as the governor of the Bank of Japan, and he's handing over to Ueda. And will this be a period where actually they can shift the way they think about monetary policy? And that will have a big influence on global fixed income markets, because it's still the big component of global fixed income markets where yields still look too low relative to policy. So I think that's the major central bank, at least I'm focusing on over the next couple of months or so. And I say it could even be as early as this Friday when things get interesting.
Yeah, and the current pace of purchases certainly seems unsustainable. So it'll be interesting to watch that indeed. Okay, so let's now pivot to what it means for fixed income markets. Can you tell us how our interest rates are affecting the demand for fixed income securities right now, and what implication does this have on investors?
So we've obviously seen a huge repricing in the bond markets over the course of 2022. We went from 1.5% on a 10-year US Treasury. We're up hovering around 4% at the moment. And I think how we're looking at it is that this is becoming a very interesting market for investors. There are a number of people out there that I talk to that just haven't been interested in fixed income or in bonds for the last decade or so. And suddenly we're getting to levels where actually that you could argue value is back. If you look at core government bonds on a real yield basis, so the additional yield that you get owning a core bond, taking into account what the market perceives inflation to be over the life of that bond, then actually the yields, you're talking somewhere in the region of 1 to 1.5% for a number of core global government markets. And those yields are the most attractive they've been since the global financial crisis. So,
well, they were negative not so long ago, right?
They were deeply negative not so long ago. They're now positive. If you look at the US TIPS, so inflation-linked Treasury inflation protection securities in the US, you can get a real yield on the 10-year part of the curve of around 1.5%. They were negative 1% not that long ago. So there's been a huge repricing, and that's bringing people back into the bond market. People who haven't owned bonds for a long period of time, people who haven't seen fixed income as a diversifier again. We obviously had that positive correlation between equities and bonds last year, which does not help for a multi-asset or a balanced portfolio. So we are definitely seeing a huge amount of demand. That's we're not sitting here saying that we've definitely seen the highs in yields, but given the repricing, given the valuation that's been created, there's a lot of interest in fixed income markets.
Yeah, I do agree with you. And the 25 bips increase from these levels doesn't have as much impact as starting from a very low yield of 1.5%. So there's indeed a little bit more potential in holding the asset class, and that's why the 60-40 split seems to be more in vogue, especially with the equity risk premium being at almost historical lows as we speak. What about duration? What kind of role does it play, and what type of direction would you be inclined to go on right now? Are you over? Are you above duration or neutral? Or what kind of stance do you have?
So at the moment, we've got a more neutral stance on duration. We spent most of last year deeply underweight duration, at least relative to where we positioned the portfolios historically, taking advantage of what we thought was going to be a movement higher in yields. And we think we're in a spot now where, I say, bonds at least are fair value. And I think from our standpoint, what we will be looking to do is, as we continue to see yields move higher, we will be looking to accumulate more bonds. What I would like to definitely see, as I mentioned earlier, it would be great to possibly see some of those inflation levels tick down again. Not such a strong jobs market in the US to have maybe more conviction that what is priced into the Federal Reserve from a tightening standpoint is likely to be the peak, and we are likely to see the Federal Reserve pause. But I think the reality is that we are at levels now where you are compensated to buy fixed income, and as you mentioned, we are unlikely to see the scale of moves that we saw last year, and you're sitting on a pretty nice yield cushion to start with. Again, that was not something that was available at the start of last year. And then I think the big benefit from having duration at the moment, and it goes back to your point on, say, a 60-40 mandate, is bonds can now act as that diversifier if we do start to see a slowdown in the global economy, and we do start to see central banks, or we see a period where central banks are going to have to ease to support that. When you're at 1.5% on the 10-year Treasury, it's quite difficult to see a significant move lower in yields. When you're at 4%, yields could easily be 3 or 2.5% if we start to think the Federal Reserve will have to go on a meaningful cutting cycle to support the economy, and then you're going to be able to gain a really attractive capital gain on the back of the yield that's on offer. So in that environment, you would expect fixed income to do what it's supposed to do, which is to provide that ballast and diversification to a portfolio of multi-assets.
Perfect. What kind of challenges do you see investors facing in the fixed income market? And are there any steps that they could take to address them?
So I think the main challenge that we're seeing at the moment is just how strong the credit markets are. So if I look at the high yield space today, we've seen spreads tighten over the course of this year, and tighten significantly since the wides that we hit during last summer. And we're now back to, I believe, a market that is pricing in that Goldilocks soft landing scenario. If you look at high yield markets today, I've got the US with a spread of around about 400 basis points. Now, the long run average over the last 20 years or so is north of 5%. So we're well through long run averages. And actually, when you look back over the last few years, really, we're off the tights. We saw tights of 330 basis points or so. But remember, that was in a period of zero interest rate policy, quantitative easing, $15 trillion worth of negatively yielding bonds. There wasn't really an alternative. You had to stretch for yield into the high yield space to be able to actually achieve the yield you'd want from your fixed income portfolios. And I don't think that's the case anymore. I think you can actually get a well diversified global fixed income mandate of very high quality bonds for pretty attractive yields today. So I do think credit markets, particularly lower quality credit markets, can be a little bit challenged. I don't really see the spreads going much tighter from here. So it's really carry you'd be giving up. So I would prefer at the moment, so how do we address this concern? Well, actually, it's to go up in quality. So it's to look at some of the higher quality parts of the fixed income space. So we do think corporate health is still remains pretty good. And we think you can get pretty attractive yields being in high quality fixed income. Just to put it in context, if you think about where the US high yield market was at the beginning of 2022, well, you were talking yields of 4 to 4.5%. You can get higher yields than that, and meaningfully higher than that, owning high quality investment grade credits today, just given the repricing that we've seen in the risk-free rate. So I think it's a world where going up in quality makes sense. And then hopefully we do see, the way we've positioned the portfolios, we do see a little bit of spread widening, and that will then allow us to reinvest in that part of the market when we believe the valuations compensate you for the risk.
What kind of spreads are you looking after? And perhaps in conclusion, what are you buying right now? What's your team's best ideas?
I think that's a great question on spreads, because if you go back through time or through history, you would say that high yield spread should be somewhere in the 800 to 1,000 basis points for a recession. I think the reality is that actually corporate health is better than really probably any period in the run up to a slowdown that we can remember over the last couple of decades or so. And we have seen an improvement in overall credit quality of the market. If you think through, the composition of the US high yield market, the double B components of the highest credit quality part of that market has gone from 40% to 50%. We've had the triple C component, the lowest credit quality, go from 18 down to 11%. So it's definitely a better mix of securities there. So I don't think we're going to see spreads as wide as you would have had through a historical recessionary environment. If we're at 400 basis points today, I would expect if you're moving towards 600, 650 basis points, you want to start accumulating bonds. And again, you're never going to hit the absolute wide in spreads, because the reality is the market will only be there for a very short period of time. So I think that's probably a pretty attractive place to start allocating. What are we doing at the moment? As I said, we are going up in quality. We're looking at high quality investment grade corporates that we're very comfortable with. We actually like some of the local emerging market bonds out there today, where we've seen central banks be very aggressive in tightening policy. They were tightening policy back in 2021, before the developed markets where central banks were participating in that. And we feel that they've got to a stage where you can get some very attractive real yields on emerging markets. So that's another area that we like. And then just generally, so we do believe that this is an environment when you want to be adding fixed income back to portfolios. So if we do see yields rise a bit further from here, I think just generally adding duration into portfolios makes sense.
Ian, this was very interesting. Thank you very much once again for being with us. Everyone, thank you for tuning into our NBI podcast. We'll talk again next month.